Hello, everyone. George DeSantis here with a look at the market. This is Thursday, October 15, so it's not the usual weekend look at the market, but I thought there's enough going on here that we should take a look at it today and see where we go from here. Where do we stand now and where do we go from here? So but let's bring up the disclaimer before I go any further. And just note that I'm not attempting to give any particular person investment advice. This is done purely for educational purposes, for my own purposes, first of all, and then it's shared as a video. Anyone can take a look, make of it what they will. So please note that as I do this now, it's exactly midday on Thursday. And where is the market at this time? Well, we can see that the S&P is is right here, which is about 34.67. This is delayed about 15 minutes, but around 34.68, 34.70. And this is a weekly chart of the S&P 500. So the first thing we like to do is take a look at the moving averages, as you know. So the 4 is above the 9, 9 above 30, 30 above 50, etc. And so we do have an uptrend insofar as the moving averages are concerned. We still do have an uptrend, okay? What else do we see on the weekly chart? We have the parabolic still below the most recent bars. So there is no indication from the parabolic that we should reverse to a downtrend. Okay. Um, the next thing we ought to look at is, let's see, the fact that we rallied all the way up here close to the 2 standard deviation line is significant, as we'll see when we get to the daily chart particularly. But notice that when that happened here, we pull back, okay? That's a bit of an overbought, very overbought region. So this is the kind of thing we're experiencing right now. If you look at the volume, volume is not, well, it's only midday, but the volume is lower than one might expect anyway. MACD histogram, the one we use for sell signals, well, that's above the zero line, so we're not getting a sell signal here on the weekly chart. Let's take a look at the daily chart. On the daily chart, you could see what happened here is that we rallied all the way from, what date is this? This was 9/24, September 24. We rallied all the way up, okay? And what happened is that we were below that 2 standard deviation line pretty much for all the way up here. And now we became overbought because we closed between the 3 and the 2 standard deviation lines here. So that's really an overbought condition. And we could normally logically expect a bit of a correction or pullback, and that's what we've been having in the last 3 days. Today is Thursday, so since Monday we're having a correction here. Monday was a big day up. Parabolic switched to being above the most recent bar, today's bar. This is midday on Thursday. And when we take a look at what's going on here, in addition, we could see that the 4 EMA is still above the 9, the 9 is still above 30, etc. So we still have an uptrend, but we're in the midst of a correction. And when we take a look at the inverse head and shoulder pattern that I discussed with you in an email, we'll see that that is called the reverse pattern of the head and shoulder pattern. But let's leave that for now. What we can do is take a look at volume. Volume is not very high insofar as today's volume is concerned. And insofar as MACD histogram, the one we use for sell signals, is concerned, we are not issuing a sell signal here yet because we should be red and below the line for a sell signal. So we're still on a buy signal here. We're still bullish, in other words, okay? Now I want to go on and discuss the inverse head and shoulder pattern that we're seeing on both the Nasdaq and the S&P on the daily charts in particular. And this is a photo of a page 114 from John Murphy's book, Technical Analysis of the Futures Market. But it's really not limited to futures. trading. You can use the head and shoulder pattern occurs wherever there's a tradable, like stocks, ETFs, forex, etc. So this is a typical classic description of it. You have your left shoulder, you have your right shoulder, you have your head here, and this is the neckline. Now, where we are now, as we'll see, is we are in that return move. We are coming back down from this peak here. We're coming back down to the neckline, and we are sitting right about in this area here, just above the neckline. What follows next should be a rally. Now, I don't believe that it's just coincidence that Larry Williams' uh, chart projections show that we should get a nice move up from October 20th. And that will coincide almost exactly with the next, with this next move here, if we get that rally from the return move on the neckline. So we'll see this when we look at the charts of the S&P and the NASDAQ. But I just wanted to show you this classic description here of the inverse head and shoulder pattern. And now we go back to the daily chart of the S&P 500, and you can see that that head and shoulder pattern. Here's your head, here's the left shoulder, right shoulder, and we had that rally, and now we're having the return move, and there's your neckline. So if we are in the midst of a classic head and shoulder reversal, or an inverse head and shoulder as it's called, what we should see is a rally from the neckline. If we drop much below the neckline here, the picture changes significantly. But let's not jump the gun. Right now, we are still above the neckline, and we are looking for a rally from the neckline. And this is on the daily chart of the S&P 500. As we saw when we were discussing this earlier, we still don't have a sell signal here, and we're on very low volume as we pull back on that return move. Here's a chart, the daily chart of the NDX, the NASDAQ, and so NASDAQ 100. And so what we can see here is the same inverse head and shoulder pattern. Here's your head, here's your left shoulder, and here's your right shoulder. And so we have that rally. And in the case of the NASDAQ, we actually hit 3 standard deviation all the way up here on that yellow dotted line. And then, of course, that was overbought, as we saw with the S&P 2. We came very overbought. And so what we're having is this return move. And there's your neckline. So we are likely seeing that same kind of pattern here on the NASDAQ. Okay? Now I plotted one of Jake Bernstein's charts. This is a 10-day moving average of the highs and an 8-day moving average of the lows. So the green line's 10-day of the high, red line 10-day of the low, 8-day of the lows. And the way I understand Jake Bernstein uses this is that when you get 2 complete bars above the 10-day moving average of the highs, then you have your trigger here. This is your setup, and this is your trigger. When the advanced decline line is above the 57-day moving average, and you get 2 complete bars above the 10-day moving average of the highs, you get a buy signal right here. And this is what followed. Now, where are we now? We are now we're making a low today at the 8-day moving average of the lows. And if I understand Jake Bernstein's approach correctly, what he says is this is a buy signal also. You buy at the bottom of the channel. This is the channel between the highs and lows, and you buy here. So this is consistent with what we saw in terms of the return move, and then we get a rally from there. So we'll see if this holds true. I want to go back to the daily chart of the S&P 500 and show you some additional things. First of all, should we get a rally from the neckline here? Where is the target? The target is 36.65 approximately. And how do we determine that? We take the distance from the neckline to the low on this bar here, this on the head of the head and shoulder pattern, and we project it on up here. And that's so the same move here, right? From this low to this neckline, we get here, and that's 36.65. So that's that. Let me show you something else. So my friend Rick Monteith from efuturevision.com, from whom I learned the 930 approach to trading, he points out in his work that when the 9 crosses above the 30, as it did right here, 9, that red line crossed above the 30, the green line, the first first close between the 9 and the 30 is a buy zone, is a good buy zone. It's usually a very high risk, not high risk, high probability buy zone. Okay, so all of these conditions are coming together right here around that neckline. Everything depends on whether we can hold at the neckline. So folks, don't let this give you a pain in the neck, and we'll try and do this again on the weekend.